talk stocks, and there's a lot of optimism coming from brokerages, namely Goldman Sachs, talking about maybe the best opportunity in a generation. Is that true? Let's go to St. Petersburg, Florida, and take a look at the market action. Jeffrey Saut, Chief Investment Strategist at Raymond James and Associates, where he helps oversee about $300 billion worth in assets, joins us this morning. And Jeffrey, what do you think? Is that true? Is it the best opportunity in a generation in equities?
I think the best opportunity in a generation was on the undercut low in October 4th of last year. If you believe the forward earnings estimates, the S&P 500 was trading at less than 10 times earnings with an earnings yield of somewhere between 10 and 11%. And if you use the 10-year Treasury as your risk-free rate of return, it gave you an equity risk premium of somewhere between 8 and 9% for valuation metrics not seen in decades.
Okay, so what about for the rest of this year? I mean, you know, we've had such a big run-up just in the first 3 months of the year. People are saying that the old age adage where you sell in May and you go away, that's going to take place this year. Might as well close down the books and take a good holiday.
I'm not so sure it's going to play that way. I'm a bit cautious here. We're up roughly 30% on the S&P from that October 4th of last year undercut low. I think the internal market's energy has been used up in the short run. The only question in my mind is if we kind of go sideways and rebuild that internal energy, or if you get something like a 3 to 8% pullback. In any event, I think any pullback is for buying, and I think equities will be higher by year end than they are right now.
How much higher?
You know, the markets always do more than most strategists or economists expect. So in terms of putting a price target on it, I have no idea as to how high we can go here. I will tell you that the world and U.S. endowment funds are profoundly underinvested in U.S. equities, and when it becomes apparent that the U.S. economy is not going to slip back into recession and that interest rates are going to trend higher right here, I think there's going to be a massive shift out of fixed income and into U.S. equities.
Okay, but what about the concerns voiced by Ben Bernanke saying that, I guess, the recovery could be derailed by the high oil prices? I could make an argument that because of the extremely mild winter that we've had over here, that at the margin, if oil prices don't trade a whole lot higher, if there's not a geopolitical event like a blockage of the Hormuz Straits or some geopolitical event like that, that this economy can handle marginally higher gasoline prices. And our premise is that over the next 3 years, you're going to see almost a doubling in oil production in the U.S., and this country is going to move towards energy self-sufficiency for the first time since Jimmy Carter talked about it in 1976.